good evening, everyone. Thank you for being here and for joining us for 5 things you should know about investing with Tom Rizzo. My name is Diana Cervera, and I'm the Director of Education with California Lawyers for the Arts. I'm very excited about today's topic about financing and securing our financial futures. I know that there are a lot of artists, freelancers, and arts administrators in the audience. So for those of you who are not familiar with California Lawyers for the Arts, or if this is your first time joining us, welcome. I'd like to take a quick moment to share about California Lawyers for the Arts and share some of the benefits about joining us as a member. CLA is a statewide nonprofit organization serving the arts community by providing a number of legal and educational services across the state, which include educational webinars like this one, legal clinics, symposia, and we also have a lawyer referral and information service, which helps provide accessible legal support to the arts community. Membership with CLA helps you save up to 50% on educational programs, save $15 off of every legal referral fee, and will allow you to enjoy discounts on our video on-demand library of workshops and MCLE programs. You will also have free access to recording workshops in our upcoming foundational series, which will cover fundamental intellectual property topics. Feel free to screenshot the image on the screen and follow us on social media through your preferred platform. Keep up to date with our programmatic offerings across the state. With your support, CLA continues to provide critically needed legal support, conflict resolution, and educational programs for artists and arts organizations throughout California. So once again, welcome, Tom. Now, without further ado, I'd like to read a little bit of an introduction for you, Tom, and then I'll pass the mic over to you. Tom Rizzo is founder and managing director of Plectrum Advisors, an independent financial planning resource serving the freelance community. Tom works with clients on an individual basis to evaluate their needs and goals, both short and long term, to help secure their financial future. Through a comprehensive assessment of risk tolerance, time horizon, and financial goals, he designs an individually tailored solution that works best for you. Tom delivers common sense wisdom about how anyone can secure their financial future by adhering to a few simple tenets. With over 30 years of experience in the music business, Tom has made a successful living as a guitarist, composer, and arranger. Thank you. And once again, welcome, Tom.
All right. Thanks, Deanna. Appreciate the introduction. And welcome, everybody. Thanks for joining us. As Deanna pointed out in a little introduction, I am a freelancer myself. I have earned my living as a musician, a composer, guitarist, and orchestrator for over 30 years here in Los Angeles. And I started this company, Plectrum Advisors, to specifically help my colleagues who do the same thing. They're all freelancers, mostly musicians, but other artists as well, photographers and designers and that kind of thing. And, I came to understand that freelancers have a very unique situation regarding finance. You don't get regular paychecks. You can't go to a normal financial advisor and answer the normal financial advisor questions, which are, where do you see yourself in 5 years? Questions like that. Because when I went to see these guys when I was first starting, the thought that went through my head is, I don't even know where I'm going to be working or if I'm going to be working next week. How can I tell you, what my goals are for 5 years? So that was a bit of the genesis for wanting to learn how to invest in the absolute best possible way for a freelancer, which was myself and my wife. My wife's also a musician, a freelance musician. We have been fortunate to be successful in the Los Angeles music community, but we also paid very close attention to investing our money, especially early on. And my kind of mission in life with this new company is to pass this information on to others who are, especially those who are earning their living as freelancers. So a couple of weeks ago, we gave a webinar presentation that focused on the planning aspect of finance. And the planning aspect covered such things as getting your emergency fund together and getting your credit card debt down to zero and how to figure out how much to take out of each paycheck you get and send it to an investment account such that you'll have a nest egg for yourself when retirement comes along, and how to find an advisor that is well matched for you. And we touched a little bit on investing, where we talked about that we don't recommend that you ever buy any individual stocks, that you would buy funds, mutual funds or index funds, preferably index funds. And these funds would have hundreds or thousands of stocks in them, and you buy a share of those. And the reason for that is you really need to be very, very well diversified. That means spread out over many different areas in order to be a success for the long term. So that's what we covered the last time. This time we're going to delve into some of the more specific specific things that govern becoming a successful investor and what to expect, what not to expect, what to pay attention to, what not to pay attention to, and very specifically in the current market that we are in, where we're in a fairly significant market pullback. Currently, markets are down 16, 17%. They were down as far as 25% a few months ago. They've come back a little bit, but we've had many conversations with many either current investors or people who are thinking about investing, asking, well, what does this mean and how should that influence what we do as investors? So we're going to talk about those kinds of things. I tried to boil this down into 5 key points, and hopefully by restricting this to these 5 points, we can hopefully get some clarity for you, and hopefully that the 30 years of experience I have doing this, I can impart some of this knowledge to you so that you can not only become more successful with your investments, but more importantly, that you can feel better along the way and feel like you're doing the right thing. So the very first one of these 5 tenets, the very, very first one of these, and this is before you decide how much money do I have to invest? What is it I should invest in? Should I be taking risk? How much risk should I take? Before you think about any of those things, the very first thing you need to think about is what's your objective? People say, well, what do you mean what's your objective? Well, what I really mean is when in time are you going to need some of this money that's invested? Are you going to need it 5 years from now? Are you going to need it 30 years from now? Are you going to need it 3 years from now? 15 years from now? And why does this matter? Well, one of the main tenets that influences how you invest or what things you will invest in is your objective, your timeline. How long before you need this money? For instance, if you're 30 years old and you're saving for your retirement, which might be 30 or 35 years from now, you're going to invest in a radically different way than if your timeline was 3 years. Say you're saving to buy a house and you say, I want to invest this money and have it grow and be safe and be there when I want to buy this house in 3 years. You're going to invest it in a radically different way if you need the money in 3 years than if you need the money in 30 years. And if you're 20 years old, you may not need this money for 45 years. So that will even influence it even more. So the very first thing to think about is not how should we invest, but when do we need some of this money? Now that sometimes takes a little bit of thinking because you may have more than one objective. Most people at least have the objective that they want to be secure when they retire so that they have money to live on. Most people have that as an objective. So you might want to carve out a certain portion of whatever you're investing. That would be we would call that long-term investing. You also might be saving for a house or saving for your kids' education, which might be 15 years in the future or something. Those assets would be invested in a somewhat different way. And we're going to talk about that as we go on here. So defining your objective, and this is not something necessarily that you're going to do in 5 minutes. This is something that maybe you would think about. The second most important thing to know, before the pandemic hit, we used to go out and speak in person to groups and to give this kind of presentation in person. And one of the things I would say to audiences, and I got to laugh every time I would say, one of the things that you should never, ever, ever do is watch finance guys on TV. And it always gets a laugh each time, and I'm being somewhat facetious. But what I mean by that is the finance guys on TV are talking about the very near term. They're talking about the effects of the economy or the effects of the political movement or the effects of inflation on very near term time horizon. What's going to happen this month, this week, this year, even over the next couple of years. But the fact is, everything that they're talking about on television will have absolutely no effect 10 years from now. It will be completely irrelevant. So the kind of half humorous thing that I tell people is don't watch these guys on TV. The reason for it is you can get whipped up into a frenzy or a panic, especially when we're in market pullback conditions like we are now, and think that maybe you should be doing something different than what you were doing before the pullback happened. And the fact is, successful investing is a marathon. It's not a sprint. It's taking very measured steps at every time. It's putting some money into the market constantly, no matter whether the market's up or whether it's in a free fall. That ignoring all of the effects of near-term conditions is the main key to success in the stock market. We're going to talk a little bit more about that as we go. So, I'm old enough to have been through an enormous number of significant market pullbacks. I remember in 1987, Black Monday, when the stock market dropped 25% in one day. I remember the dot-com bubble burst in 2000, when almost all tech companies suffered severe declines. And then, of course, the financial meltdown that happened in 2008. I was an investor and around for those times. And, you go through enough of these things and the light bulb begins to go off that says, no matter how bad any situation is, the stock markets always recover as long as you have a diversified portfolio, as long as you're not betting your stake on 1, 2, or 10 different stocks. As long as you're diversified, no matter what happens. And every time there's the famous, the scariest or the most feared words in finance are, it's different this time. And it's said in every situation, including the ones that I just mentioned. And the implication of that is, because it's different, we won't recover. And the fact is, global economies will always recover. I've done research back 250 years in stock markets and economies. And no matter how bad things get, and they can get pretty bad, there is always a recovery. So if you have a timeline that is out past when the recovery is going to happen, then market pullbacks, like the one that we're in, are a non-event for a long-term investor. For an investor who's got 10 plus years, it doesn't really matter that things are down now, because they are not only going to recover, but they historically go even higher than the previous highs. So,
Tom, can I just ask a question to maybe connect both of these?
Sure.
Like when a person is working with a financial advisor, right? I know you're talking about long-term goals. And I think what I'm hearing is essentially like, if you have a diversified portfolio and your objectives are long-term, then market pullback shouldn't be something that you should be fearful of. Obviously, they might impact you. But what about folks with short-term goals? Are there different considerations they should take with like market fluctuations?
Yes.
I know we'll probably get to this, but connecting this a little bit.
That's a great question. If you have shorter term goals, let's say, 3 years, you want to buy a house or buy a car or send your kids to school or something like that, you would not invest in assets that were at risk to decline over a short period of time. So you would be in things that would have lower returns, but they would be less risky. Like, let's say you might buy a 2-year treasury bill. A treasury bill is debt that's sold by the government, the U.S. government, and they're paying, or right now they're paying 2.5% to 3%, something like that per year. And these are guaranteed not to decline. So if you bought a 2-year T-bill, you'd get your 2.5% or 3%, and at the end of the time period, you'd get your money back, and there is no chance of it declining. So if you have a shorter term goal, then you wouldn't be involved in or invested in the stock market. You would buy bonds or treasury bills and that kind of thing that would protect against a decline. So that's how we treat short term versus long term. It also can be a mixture. Let's say you've got 6 years. So in 6 years, maybe we want to try to go for some growth. So we would have a certain percentage of this in the stock market and a certain percentage of it in the safer bonds and that kind of thing. And again, this is something that you really need the expertise of a well-seasoned investor to really tease out, when you got to be really clear with me. When do you need this money? And knowing that is going to influence how we invest, so that if we're investing for growth, it's a different story than if we're investing to be able to preserve it's called preservation of capital kind of thing. Does that answer your question, Deanna?
Yes.
Yeah. Okay, good.
Thank you.
So, and then just one last, there's kind of another way to put what we just talked about in terms of the psychology of market pullbacks and the meaning of a market pullback, like the current one that we're in. When I was out speaking and to in-person crowds, one of the other questions I would ask, one of the first questions I said, in the history of the stock market, how many times has the stock market recovered from catastrophe for people who have a diversified portfolio? How many times has it recovered? And the answer is every time. It's always recovered. There has never been a situation, go back 200 years, that it has not recovered as long as you're diversified. This was a really big aha moment in my education as an investor, because I was able to say to myself, as long as my timeline is long enough here, I don't care what happens. I mean, thing can fall completely, can fall 50%. I don't care. Not that I'm happy that it's happening, but I'm saying in terms of what it's going to mean for me, it will not mean anything for the growth that I'm expecting 15 years from now or 10 years from now. It's a non-event. So historical perspective, I think, really helps gain an understanding of that kind of thing. So let's move on here to, Deanna, let's jump all the way to the end here. I've never been a very good rule follower, so I'm gonna jump all the way to my last one here. And the reason I'm jumping ahead is it just kind of occurred to me when I mentioned that one of the aha moments I had when I was decoding how this works and how to do this really right. There was a moment in my personal investing history that I realized I was never never going to need all of this money at one time. I think a lot of people have some unconscious assumption that at some point in the future, everything they're investing, they're going to call their broker or call their advisor and say, sell everything and give me the cash, and I'm going to put this big pile of cash on my kitchen table. And that's my stuff. That's what I invested for. It's kind of an unconscious assumption. So a couple of things. First of all, that's never going to happen. You're never going to sell all of it and get completely out of the market and put it on your kitchen table. You're going to take some of it. If you get to retirement age, you're going to peel off some certain percentage of this on an annual basis to help with your living expenses, to help supplement your Social Security, your pension, or any work that you're doing, or royalties that you may be getting, that kind of thing. It'll be a supplement to that. But there is no case where you're going to sell everything. So what does this mean? Well, this means when we have a market pullback like we had, and let's say you had $1 million and the market declined 25%, like it did back in February or whatever the date was, or March, it was down 25%. You'd log into your accounts at, Schwab or TD Ameritrade or Fidelity, wherever you are, and instead of saying $1 million, it would say $750,000. You've lost $250,000. And I had clients call me up and say, I've lost $250,000. And I said, you haven't lost anything unless you sell. If you don't sell, and why would you sell? You don't need the money now. You're investing for 8 years from now, or 12 years from now, or 30 years from now, whatever it is. So if you don't sell, you haven't actually lost anything. It's just a number. And again, if we look historically, the markets always recover. So your money's coming back as long as you stay put and as long as you don't do anything foolish and allow the fear of looking at these numbers to say, maybe I should be investing differently. Maybe I should make some changes. And there are advisors out there that do this. They say, oh, we're going to get out. We're going to wait for it to come back and we're going to get back in. And that never works. And the reason it doesn't work is can't see the recovery coming. It happens so fast and they're false starts and then it'll go down again and up again. And then you say, well, is it really here to stay? And if you get out, you're going to miss a large part of the recovery and you will not be anywhere near as in good shape as if you had just stayed put and understood that just because it's down 25% now doesn't mean I've lost 25% of my money. So what's missing from the calculation when you log in and the $1 million is now down to $750,000, that's that unconscious assumption kicking in saying, I'm going to sell it all and put the money on the kitchen table. And that's why it's only going to be worth $750,000 instead of $1 million. That is never going to happen. You're never going to sell it all. Even 30 years from now, you're not going to sell it all. So time is missing from the component of when you log in and you look at the percentages. What's more likely, if we could skip ahead to your retirement times, what's more likely is whatever the size of the pile that you've accumulated, you're going to take a percentage, and industry standard percentages are 4%, something like that. So you stay invested and you're going to take 4% of that pile out on an annual basis to live on or to supplement your living from your other sources of Social Security, pension, work, that kind of thing. So if you had $1 million, 4% of that is $40,000. So you're going to take at retirement time 4% of that $1 million on an annual basis to live on. So let's think about the worst case and let's think the day you retire, the market declines 20%. And instead of being $1 million, it's now worth $800,000. 4% of $800,000 is $32,000. That's what you're going to be able to take out in that year. So what have you lost? You've lost the difference between the $40,000 that you would have taken out if it was worth $1 million and the $32,000 you'll take out if it declines 20%. 20% is pretty significant pullback. The difference is $8,000. That's how much you've lost. A 20% reduction, which is huge, from your $1 million portfolio costs you $8,000. Most people I know say, I can live with an $8,000 loss. Maybe I can't live with a $200,000 loss, but an $8,000 loss I think I can live with. And then we go to the next year, and as the market begins to recover, and we'll go back and come closer to approaching the $1 million and eventually go further than the $1 million, you will end up being made more than whole at that time. So I don't know if this is clear. I tend to do these math figures in my head a little quickly, but so the better way to think about it when you see a pullback in your assets is to go back to that 4% rule, which is that's probably what you're going to pull off of these things when you're retired and say, well, how much have I really lost here? And in the $1 million scenario, you've lost $8,000. Now, nobody likes to lose even a penny. $8,000 is a lot different than $200,000 in terms of the gravity of when you put your head on the pillow at night and say, oh my God, what has happened here? And it's that kind of understanding, I hope, that can make people feel feel way differently about their asset values as they go up and as they go down, and to expect that, someplace in there, this market's going to go here and it's going to go down, it's going to go here. It always goes higher than it ever was. Always. Hard to believe, but always. You look back historically, hundreds of years, starts here and it's doing this, going up and up, but always you look over from this year to 10 years, it's always up. So know that it will be that in the future. We can't predict exactly what, but we know that it will be. Companies are becoming ever more productive all the time, which will make them ever more valuable. In any short-term time period, who knows what's going to happen? I can't predict when we're going to come out of this current crisis. Inflation is certainly troubling, but it's going to get under control at some point. And when the economy recovers, the stock market will also recover. So I take great comfort as a person who, we manage tens of millions of dollars for people. And I sleep just fine at night, even when pullbacks happen, because I know what my clients' timelines are, and I'm not concerned. I know it's coming back. And as a matter of fact, we continue to invest. And we look at market pullbacks as opportunity. Everything's on sale. It's time to continue to buy. So I know I skipped to the end there.
No, that's fine. Can I interject a question, Tom, with this? I think just to reflect back. So what I'm hearing is also part of, folks that have never invested or completely new to this. I think it's like understanding sort of the nature of investing and these pullbacks and sort of that fluctuation. So I guess my question could be like, for someone that maybe is thinking about starting, would you advise folks to wait until there's some, or just even if there's
never.
Fine, okay.
Never. The biggest mistake that's made by investors is trying to time the market, either on the downside or the upside. To be successful, you have to completely tune out any market timing issues and any emotions that go with it. And when you have capital to invest, that's the time to start. Now, we do have what we call dollar cost averaging, which means if you've got a chunk of money, whether it's $10,000 or $10 million, you would never put all of it in on one day. You would divide up whatever chunk of money you have into maybe 5 or 10 pieces. So let's use the example of having $100,000 to invest. Let's divide that up into 10 pieces of $10,000. And on the first of every month, or in the first week of every month, you would buy assets of a diversified portfolio in the first week of every month. And you wouldn't look at the stock market. You wouldn't look, are we up? Are we down? Are we in a free fall? Is it going to go lower? Is it going to go higher? And this is the way we run our business. When people give us millions of dollars or hundreds of thousands or $10,000, we decide ahead of time. We make a little chart and we set our alerts. We say, okay, there's going to be 10 buys for this client. If they gave us $10,000, there's going to be 10 buys of $1,000, January 1st, February 1st, March 1st, April 1st, etc. for 10 months. We decide ahead of time what we're going to buy. This is this diversified portfolio we talked about. And we get an alert, and the alert comes, it's time to buy for this client. We don't look at what's going on in the market. We buy it that day. We push the buy button and we rest easy. We don't even look at it. And the next month, we just do the same. And for 10 months, you get this money in. What does this do? It allows you to buy more shares of these funds when the price is low, when the market's in a pullback like now. And then you buy fewer, you're able to buy fewer shares when the market's higher, because the price is higher. But overall, you're going to end up with a really good average price per share over the time period. So people say, well, why don't you, just buy it all when the market's low and don't buy it all when the market's high? Well, you can't tell whether the market's low or high except in looking backwards, in retrospect. From where we stand now, we can't tell. Is it going to go down another 50%? Is tomorrow the recovery going to begin? Is it going to shoot up? You just don't know. So, and there's nobody that knows, including the smartest guys in the world. Nobody knows. So what we say is we accept this fact. We can't know. And that's fine, because if we have a time horizon that is going to allow us to ride out the bumpiness of this thing, then we're going to decide ahead of time what we're going to buy, the pieces that we're going to buy, and we set our alerts, and we just buy them. And statistics will show that this method beats every kind of market timing, every kind of stock picking over time. This method is the better method. Now, part of the problem with this method is there's no bragging rights. You can't walk in over some of your friends and say, I'm dollar cost averaging my assets, and we're doing $1,000 this month and $1,000 for the next 10 months, and I'm looking to get the best good average price per share over time. You can't walk in like somebody can walk in and say, I picked a stock, I bought crypto, or I bought medical marijuana something, and it shot through the roof, and I made $25,000 yesterday. Those are bragging rights. You have no bragging rights with this method. It's very boring, and I like boring when we're talking about my assets and my secure future. So it's difficult to shut out the influence of others who don't do this, and there are many. And we'll get back to going back to the finance guys on TV. You'll see guys guys yelling, get out of the market. Now it's going to crash. Now's the time. Or get in, now's it. None of those are what you want to do. It never works. Not in the long term. In the short term, it's like guys who go to Las Vegas. They can win and they'll come back and brag to you that they won. But over time, they eventually don't beat this method of tried and true, very methodical, no emotion, no ego. It's, I know this method works, and this is the path to long-term success. I also want to share a little anecdote about a woman I helped. I think I may have talked about this on the last one. So we have, I don't know who's in our audience, but there are people on all ends of the spectrum. There are people who are sitting on $6 million, and there are people who have $6,000 or less maybe. And people think that maybe you treat those two situations differently. This woman that I wanted to talk to you about, she started when she was 31 years old, and she wasn't actually making much money. I think she was making, I want to say $30,000 a year. So not wealthy by any stretch of the imagination. And we sat down and we did a little calculation based on historical records that if she took 10% of her salary, so if she's making $30,000, that's $3,000 per year. That's less than $100 a week, right? $80 a week, something like that, $70 a week. And she did that for the next 35 years. And we looked at and bought what I'm recommending, which is this very balanced, diversified portfolio of index funds. We'll talk a little bit about index funds in a minute. We said, what's she liable to have by the time she gets to be 65? So we ran the numbers and we looked back at historically what the stock market has done in many different 35-year periods. And the shocking number was that by the time she was 65, she'd have $975,000 in her account by essentially just keep putting the money in, doing the once a month. You're going to do dollar cost average this thing over a long period of time here. It assumed she would get a little bit of a raise, maybe a 3% raise a year. I think we built that into the formula. But it shocked her to know that even someone who's not necessarily making a lot of money can end up with almost $1 million at retirement time, just not doing a heck of a lot. So this was encouraging to her that, there are achievable goals here, and you can scale that up, that if you're fortunate enough to be able to making more than $30,000, let's say you're making $300,000. Imagine what you can have at retirement time in terms of assets that are going to make the rest of your life way better than if those assets weren't there. So let's see, what else should we cover here? I guess we've already talked about fourth point, which is investors that talk about, or advisors that talk about getting in or getting out of the market, putting your money in now. Is it a good time to put it in now? Or should I get out now? And you hear a lot of this kind of thing, especially in extreme times, and we're in kind of an extreme time. We're on the extreme downside. There are also extreme times when it's on the upside. And when it's on the upside, you have the guy saying, I think we should get out, meaning I think we should sell because I think nothing good is coming. And when we're in times like we are now, where we're in a decline or a pullback, saying, well, now's a good time to get in. Well, the fact is, neither of those are investment strategies. They're gambling on moments in time. They're saying, I think this is the high, or I think this is the low. And the fact is, none of us can know this. Not even the smartest guys in the world can know this. So the advisors that have the get in, get out strategy, like, oh, we'll get out, and then, when it starts to get back in, we'll get back in. Those things never work. And in addition to not working, you end up being a nervous wreck because you're watching the market every day. And when it goes down, the other day it went down 4%, it goes down 4%. Oh my God, what? Is now the time to get in? Or is now the time to get out? And anytime we have emotion, either positive or negative, come into an investment mindset, it's a recipe for disaster because you're going to be motivated to make a stupid decision because you're frightened or you're elated. The best way to do these things is to make all of your investment decisions in very calm times. Focus on your objective, like what we talked at the beginning. Your objective to build a retirement fund. Okay, if that's the objective, then we got to back in is how much are we going to be able to put in on a regular basis? Who cares what the market is doing this year, next year, 3 years, 5 years? Doesn't matter because we know historically this thing is always going to climb. Have to stay diversified. Can't say I just want to buy Apple stock because I think Apple's going to be hot. That's a mistake. Could pay off. Not saying it couldn't, but you don't want to take that kind of risk, and you don't need to take that kind of risk. So I think that pretty much covers most of what I wanted to talk about here, Deanna. Do we have any questions?
I think one thing that maybe, Tom, that you could unpack more that I know we spoke about last time and has come up in the audience previously, and I know you just gave this anecdote of the woman that, maybe, didn't have a ton to invest, but still could have, over longevity, a big return. Could you talk about that maybe for folks with like shorter term goals? Like, I know that was like a 35-year wait for those of us that are in our 30s. It's like, maybe that's a good idea to do right now. But what about for shorter term goals? Is there any strategies that could help folks that maybe, don't have a ton to invest? Any advice around that?
Yeah, sure. And it's maybe something that we touched on a little bit in the last webinar. I think the anecdote you're referring to is there was a woman I was working with on a music project, actually. And she also knew I was a finance guy. And she was intimidated she wasn't particularly good at math, and she just hadn't ever invested, wasn't a particularly good saver. And somehow we got into a conversation, and I said, if you're open to it, I could help you. I can help you figure this out. And so she was good. She said, okay, sure, let's try this. So the first thing I did, as I said, I want you to take 10% of every check you get and send it to your investment account. I created an investment account for her at a brokerage, and just kind of as a favor to help her. And, she said, well, I don't have any money left over at the end of the month. What do you mean take 10%? I can't remember how much she was making, but she was just kind of making ends meet. And she said, but there's no money left over. And I said, well, just humor me and just try this for 4 months. Just, you get a check, and she was a freelancer. So she'd get a check for $5,000. She'd get a check for $50, get a check for $200, get a check for $800, and all these just jobs that she was doing. So she got the $800 check. I said, take 10% of that, which is $80, and take it out and just take it right out of your hands and send it over to the investment account. So before you even think about what you're going to do with that $800, reduce it from $800 to $720. That's taking the 10%, the $80 out, and send it over there. And then when you get the $200 check, take $20. That's 10%. And so now you got $180, and just send it over there. So just humor me, try this for 4 months, and let's have another conversation. And we were kind of at the end of of the project we were doing, and so I didn't see her. I didn't know whether she was going to do it or what happened. I just got busy and we kind of lost touch, as freelancers do, right? So she calls me up after 4 months, and she said, you're not going to believe it, but it's become the new normal. I did what you said. I got the $1,000 check, and I took $100 out of it before I even thought of, well, what do I have to pay? And I sent it over. And the $500 check, I took $50 and I sent it over. And the $2,000 check, I took the $200 and I sent it over. And she said, somehow I figured out how to live. It was kind of just like another bill I had to pay. You pay your bills at the end of the month. You got water, gas, electricity, rent, your car payment, gas, all of that stuff. And it was just another bill I was just paying, except I was doing it with every check. I sent it over. And at the end of the 4 months, all of a sudden, now she's got this beginnings of a little nest egg going and she feels exactly the same as she did in terms of living. She said, I don't feel deprived. I don't feel like I can't do stuff. I just adjusted. Almost like my rent went up, a little bit. Or I had to get a new car and I got to make a car payment every month or something. Said it was something I adjusted to. And so I kind of likened it to the concept of work taking up as much time as you allot to it. So if you've got 5 hours to do a task, whatever the task is, it's going to take you 5 hours, right? You're going to spend all 5 hours on it. If the boss comes in and says, you don't have 5 hours anymore, you got 2 hours to get it done. You go, I can't do it. But somehow you figure out how to get it done in the 2 hours, right? Might not be as good as if you'd spent 5 hours on it, but you get the thing done, right? You get the task done. This is kind of the same way. You say to yourself, I don't have any money. How am I going to save? Well, if you use this method and you take 10% of every check that comes in, whatever it is, and just take it away from yourself and throw it over there. And now you look, and instead of $1,000, you've got $900. It's 1,000 minus the 10%. Somehow you figure out and you adjust. And in this case of this woman, it took about 4 months before it felt exactly the same in terms of her budgeting and what she could do. And in addition to having it feel the same, now she's got this little engine beginning to work for her. And she's got a method to be able to kind of build this pile. And then for the rest of the story is I helped her to invest that money and showed her how to continue to invest it and that kind of thing. And so now she's on a path, and now it's just another bill. Was that what you were asking about, Deanna?
Yeah. Just, I think that covers it. It was just about like folks that maybe feel like they don't have a ton to invest right now. Like I think the answer is like you can still invest, right? Like I think that's great. So
let me go even one further. I recently took on a client who's 9 years old. Now, he's not legally allowed to have an account by himself, but we set up a custodial account, which means his aunt set up this account. She owns the account. He's the beneficiary. And he's mowing lawns and babysitting and doing stuff like that. And she's teaching him. She said, take 10%. You get $10 for mowing the lawn. Throw $1 over there. That's 10%. Or you go babysitting, you get $25. Put $2.50. So at 9 years old, with no money, right? He's started this getting accustomed to, this is what you do. You take 10% and you put it over. It's teeny, but if you get in the habit of this thing, it will shock you after a few years where you see this pile of money sitting over there going, where did that come from? So sorry, I didn't mean to interrupt with my 9-year-old.
No, that's great. That's great. I think that it's like great advice because I think, there can be folks on both spectrums, right? And I think it can feel overwhelming. So I think knowing that it's not like inaccessible to you, starting to invest or have financial literacy. So that's great. Thoughts on dividend stocks or dividend index fund?
Okay, let's define a dividend. Every company that issues stock at the end of the year or quarterly, they assess how they're doing. And if they're making money, which means they're making profit, most companies return a portion of that profit to the shareholders. So if you're a shareholder, let's talk about single stocks for example. Let's say you own Apple stock. And if you own 10 shares of Apple stock and Apple declares a dividend, and it's usually a dollar value, like it's $2 or $4 per share. If you own 10 shares of that, they're going to send you $40 in dividends. So that's what a dividend is. The dividend is in addition to any growth or loss that a stock can occur. So if the price of Apple stock goes up 20% or something, this dividend is in addition to the gain that the stock can have. When you own which is what we recommend, an index fund or a mutual fund, inside of these funds are many stocks, hundreds, thousands of stocks. And all of the companies in there are subject to declaring dividends. Most of them do. And when they do, then you are given the dividend and you can take it either in cash or what we recommend is we reinvest those dividends. What does that mean? Tell the company, don't send me the cash, just buy more shares of this index fund. Buy like 1.3275 shares of the index fund and put it in my account. So this is a good thing. And reinvesting the dividends over the long term can have a significant impact on the growth of your portfolio versus taking the cash dividend and putting it in your piggy bank or going and buying a new pair of shoes or something. So we recommend that you automatically, and you can set this up automatically when you can talk to your advisor how to do this. Whenever dividends are declared, you should reinvest them, which means company will just issue you more shares of that stock, that index fund stock. Now, your question specifically is what about dividend stocks? There are companies out there that say, let's focus on buying shares of stock that issue good dividends. And I think that's what the question was, is should we look to buy companies or index funds that focus on companies that issue dividends? While this sounds like a smart thing to do, that if they're giving their money away, let's buy those shares so that we can get that money. It's somewhat misguided because dividends aren't the only component in the growth of your portfolio. That if what you ought to be considering is in your diversification scheme, which companies do we want to own that are growing? Which companies are undervalued? Which companies are large? Which companies are mid-sized? Which are small? Which are in the United States? Which ones are in Europe? Which are in the emerging markets? Which ones are in Africa? That mix of deciding which companies to own is a better strategy for growth than restricting your thinking to let's focus on the ones that are declaring the dividends. Because the dividends are only a portion of the growth of a portfolio. And I believe if you restrict to that, while you'll get the dividends, and that's good, that you will be restricting yourself from the greater growth that can happen with a more diversified portfolio. Does that answer the question?
I think so. In addition to buying index funds, what are other ways to diversify your investment portfolio?
Well, there are what are called, first of all, I don't think you need to diversify your portfolio in anything except index funds. Came to me as an advisor, that's all we do. Now, there's thousands of index funds out there, and an index fund by nature has stock in it of many companies, thousands of stocks. If you buy an S&P 500 index fund, it's going to have 500 stocks in it. If you buy the Russell 2000, it's going to have 2,000 stocks in it. If you buy the Russell 3000, 3,000, it'll have 3,000 stocks in it. So the level of diversification you get with an advisor who knows which index funds to purchase for you and in what ratios to hold these things, you're plenty diversified by doing that. Now, the specific, so this would be my recommendation. Now, are there other things out there? There's all kinds of things out there. There are alternative investments. There are real estate investment trusts. There's the whole crypto universe. There's all kinds of other non-listed companies, which means they're difficult to trade. That a lot of advisors, hedge funds do this kind of thing, where they're taking chances on things that are kind of outside of what the normally traded things. Private equity. I don't recommend any of those things for anybody that doesn't have $100 million. If you've got an enormous amount of money, then maybe this might be worth looking at as a way to take a chance that maybe you could amplify your returns. But these things carry significantly more risk, and as a result, I don't recommend this for the average investor. Like I said, anybody under $100 million, I wouldn't touch with a 10-foot pole myself.
Thank you. How do investment advisors charge clients? Flat monthly fees or a percentage of invested funds?
Okay, that's a good question. There's a couple of different ways. The two main ways are either by charging commission on the products that they sell, and by products I mean the funds or stocks or insurance policies or whatever they're selling you, or they charge a percentage of the assets that they manage for you. So on an annual basis. So what does that mean? If you have $500,000, the advisor will charge you 1% of your assets annually. If you have less, if you've got $75,000 or $100,000, they'll probably charge you 1.5% of those assets on an annual basis. And they can bill you either monthly or quarterly on this. So we have the two models. We have the commission model, where they'll charge you a commissioned rate to sell you a stock or a fund, or the assets under management fee structure. I personally think the assets under management fee structure is superior for the client because it removes the conflict of interest that the advisor may have if he's on commission. It's like any other commissioned sales situation where the advisor is motivated to sell you something because that's how he makes his money. On the assets under management, we would never think of selling something, by selling I mean buying a stock or a bond or a mutual fund, based on how much we're going to make because we sell that. We would be selecting, we're going to get paid no matter what. We're going to select the best possible product for the client given their objective, their risk tolerance, all the things that we talked about today. So I would recommend, if you're looking for an advisor, shopping for an advisor, I recommend finding one that charges an assets under management fee, which is what we do at our company, by the way. That's how we charge.
Perfect. How do you make a decision on what stocks to buy or pick, certain index funds over others?
Very long answer. We probably don't have time for it today. In most cases, there are rare exceptions, but in most cases, you're better served by finding an advisor and having the advisor do this for you after he's interviewed you and found out what you want to do, what's your objective, what you're trying to do, what's your timeline, how much money are you can you commit to this? I think it took me 15 years of study, 30 hours a week to get this right, to figure out what was the exact right thing to do, to hope that someone who this is not their full-time job and that you're doing something else, to hope that you're going to get this right by, what should I buy? What stock should I buy? What fund should I buy? It's such a deep subject in terms of the ramifications and how you quantify this that I don't really recommend that people do it by themselves. Now, again, there's exceptions. I was an exception, right? I decided to figure out how to do this myself. But for most people, I think you're going to be better served, even though you have to pay the advisor, you're still going to do better, even paying the advisor, because it's kind of a professional. It's kind of like, doing your own plumbing at home, I guess you could figure out how to sweat the pipes together and put it together. But, at the end of the day, calling in a professional is really going to get the job done in a better way than you can.
Thank you. And I think this is maybe a good one to wrap with, Tom. Will it be better to start a 401k investing through work or take a different method for retirement savings for older folks?
There are some advantages for 401ks and there are some disadvantages. The prime advantage, so for people that will just define a 401k is a pre-tax vehicle, like an IRA is. You put money into a 401k before you've paid the tax on it, and then when you take it out 20 or 50 years from now, whatever it is, then you pay the tax on it when you take it out. It can grow in a tax-deferred environment, which is a good thing. The prime there are two prime advantages for 401ks. One, the contribution limits in a pre-tax vehicle are significantly higher than they are in an IRA. Currently in an IRA, you can only put $6,000 a year in if you're under age 50. In a 401k, you can, I don't know the exact number, but it's something like $20,000 or $20,500 you can contribute. So if you're making money and you can afford to put away $20,000 a year, 401ks, that's a good thing. That's positive. Another positive is that many companies will match a certain percentage of your contribution, usually up to about 6% or $6,000. Every company's got a little bit different take on how they do this. So that if your company will match percentage of what you're putting in, that's like free money. So that's a no-brainer. So the very first question to ask, if your company offers a 401k, do they have a match program? What is the level of match? And if they'll do that, that's where your first dollar should go, because it's like getting an instant raise.
Great. Thank you so much, Tom. And if you'd like to get in touch with Tom or ask any follow-up questions or look into Plectrum Advisors, the information is on the slide if you want to take a screenshot. Tom, would you like to, give us any closing remarks? I thought today was great, really succinct and very direct and applicable knowledge that you gave us today. Anything else you'd like to say to close us out?
Just that don't be hesitant to reach out. We do a lot of these presentations and we get a lot of people calling, and it's, we're happy to discuss anything with anybody, just to try to help you get oriented to start this journey, or if you've started it, to refine it so that it's going to be beneficial. So don't hesitate to, especially to email. Just email, say, I'd like to have a conversation. Even if you're saying, I'm not sure we can do anything, or but I have a couple of questions. We're happy to chat with anybody about anything. And I would just encourage everybody to reach out if they'd like.
Great. Thank you so much, Tom. And thank you everyone for joining us.